Target announced their earnings this morning before the market opened. And I wanted to take a look at their earnings announcement, take a look at the good news, take a look at the bad news. More importantly, see how they're expected to do here in 2026. Target is a stock on the rebound. For a couple of years, it's really been languishing. The stock 5 years ago is doing great, outperforming Walmart, outperforming most general merchandisers. But now the stock has not done all that great over the last couple of years. Last 3 months is a different picture, and I'll show what I'm talking about in a few minutes. For now, let me just kind of summarize what I read in the earnings announcement. In 2025, there was no growth. The company actually contracted a tiny bit. They're really getting the business on a different track. They believe they can grow the business by 2 to 4% in 2026, which doesn't sound like a lot of growth. But in this particular market, it's a big business and it's really hard to grow. They are generally profitable and they have been producing good free cash flow. I took the free cash flow and I updated my valuation with it. The 2026 year is really going to make or break the stock. If they hit the targets they're putting out there, the stock's going to do well. It's going to continue to do well. And we'll see if they can pull that off. Target is a $51 billion market cap company, and that's just a fraction of where Walmart is. Walmart's way up there at $1 trillion. The P ratio is really low, 14.8, and the dividend's really high at 4%. Now, the stock for the last 3 months is doing quite well, up almost 24%. And pre-market, now that the information of how they performed in 25 is out, more importantly, the guidance they have for 26 is out there. Investors are buying up the stock in the pre-market hours. So the stock is doing well for the last 3 months. For the last year, it's a different story. The last 5 years, different story. The stock has struggled. But this stock, as I'll show later, is not quite the most desirable stock that you can find. But if you buy stocks at the right time, you can make a lot of money. And I started investing around this range. I thought it was a good opportunity. And my stocks that I bought here are actually being paid a 6% dividend while the stock goes up, which is a winning recipe. Now let's talk about the forecast for the Target business. We are in the year that is going to complete here in February 1st, 2027. They follow the retail calendar. What that means is they don't want to close at the very end of the calendar year, right after Christmas. They want to give it a month to let people return product maybe they received as a gift. And that way they can match returns with actual sales that happened in November and December. So this is the retail calendar. And they are in this year, they're expected to grow 2%. They did guide at 2% growth. And I think the guide is probably set conservatively. They could probably beat that guide. And if they do, the stock's going to flourish. It's going to grow its profits by 5%. That looks good. And grow 6% and then 7.6%. So this growth looks really good, bringing down the PE ratio. If they get on a winning streak, the stock's going to continue to go higher. It's been doing it for the last 3 months. We also see an economic climate where consumer staple stocks, which is where Target resides, are doing quite well. At the end of the day, I know that oil prices are going up, which I expect gasoline prices will go up as well. We have the tension in the Middle East. We have some things to worry about. But the necessities we buy at Target, we'll continue to buy them. We're going to continue to go get our paper goods, our essentials over at Target. It's not like a luxury store. You generally get what you need there and fill up your cupboards and your pantries at home with the stuff at Target. So I'm expecting that they should do well in 2026 and probably hit these targets and continue to have this stock price go higher. I completed a valuation for Target and the stock is discounted by 13%. Not the biggest discount we will see out there. This is a stable stock. I think the current economy, the current tension, the geopolitical tension we have is probably going to bring investors into the Target stock since it is a consumer staple stock. The stock has been working. And when I bought the stock, it was well below its intrinsic value. Separation between the green line and the blue line is value. And catching a stock at the right time is really a recipe for making money. I'm glad I bought the shares here and I built a nice position into Target. I wanted to own more shares, but the stock just continued to go higher. With the earnings announcement, I'm open to more shares, but I'd like to see them really execute well on the business plan they've laid out. The value of the stock, it's both on discounted free cash flows. If I look at the discounted free cash flows, stock is worth $115 per share. The earnings per share are better. $154.69 is the value I calculate when I take the present value of the future earnings per share that are expected. So when I blend the two, I get $128 per share blended value. The current stock price is $113. Again, these guys pay, if you bought shares today at this moment, they pay a 4% dividend. Let's talk about desirability now. Desirability to me means how strong is their moat? How strong are they to keep competitors out of their market? How profitable are they? Are they growing? Are they very desirable? A perfectly desirable business is a good example would be like an Amazon. Amazon is number one in their categories. E-commerce, they are so number one. It's ridiculous. And they have number one position in cloud infrastructure. Their network power is massive. They have so many people that are Prime members and so forth. Balance sheet is good. Used to be great, but now it's just good because they've been spending so much capital into that data center. And their revenue growth is excellent because they're so big. They're going to be $1 trillion revenue per year company in a couple of years. They are growing by close to 11% per year, and they're already $700 billion. Think about that. It's almost $80 billion that they're adding to that top line of that income statement. Very profitable, and cash flow is very good. They get a score of 92 out of 100. So that's what great looks like. It's compared Target against great. Now, Target, I would say, against their competition, they do a good job. I think their store layout is very good. They bring a lot of people to their stores. So competition, they're good. Network power, they're also good. I think people recognize what Target brings to each community, and the consumers like what they're seeing. Balance sheet's good. It's a pretty decent balance sheet, and it could be great if they keep generating that cash. The revenue growth is a passing grade, but not good. If you're just growing at 2%, you can't get above a C for me. Okay. If you get 5% in this particular industry, I'll give you a B. Profitability, B. And it can move to an A. We'll see if they can operate better. And cash flow is good. These guys produce good free cash flow, and that can turn into an A. But their combined score is only 46 out of 100 points, landing them in the gray. And I put them right here. It's a great company. It could be a good investment. But how do I invest in great companies? Buy them when they're discounted, buy them at the right time, and have a solid exit strategy. So step one, I bought Target at a good time. They continue to be discounted. So if there's pullbacks in Target, I might add a few shares. What am I going to get out of Target? Well, if they were to get 10 to 20% above their intrinsic value, I'd probably have to take some shares off the table. Probably have to sell some shares in Target and move forward. I'm already, it's already a winning investment. In 4 months, 5 months, this has had a very good rate of return. I'm good. So if they were to go up, considerably from here, I'd have to think about taking some shares off the table. So for now, we'll see where the stock goes. If it continues to go higher, I'm just going to watch it. Probably not buy any shares. If I didn't own Target, would I be buying shares at this point? It'd be hard to pull the trigger because it's so close to intrinsic value. But if it had a pullback, and it wasn't a pullback due to weak performance or some big problem that Target is involved with, I'd probably buy a few shares because that dividend is pretty attractive at 4%. So that's my overall review of Target earnings. The earnings were good, solid. They're on the comeback. Management's doing a good job to rebuild this business, rebuild confidence in the investing community that Target could return to the heyday. Back like 10 years ago, Target was the star of the show compared to Walmart and Costco. They were doing really well. And along the way, just their strategy stopped working. They had some bad ideas, and they need to get that out of the system, get some good ideas into the business plan. And I think they're doing that. If anything, they're really trying. So we'll see if that really does work in 2026 and the stock continues to go higher. I will be checking it out, and I'll take a look at Target again in about 3 months when they announce their earnings once more for their first quarter of the new fiscal year. So that's my review of Target. Thanks so much for watching.